Hello. So let us start learning the fundamental analysis by starting with the very first parameter, that is financial analysis. So financial analysis is nothing but it is the study of business financials of the company. Now here it is important to understand and analyze the growth in terms of sales, profits, cash flow, changes in the cash, whatever funds the company is having, how the management is utilizing those funds. So all these things are important to understand, and there are different ratios for each financial parameter, and there are benchmark. That is what we will learn. Now, it is important that the company should have healthy financials, because if the company's financials are healthy, it is able to sustain and it is also able to grow or expand using its own funds. So able to sustain meaning, see, when there is an economic downturn or when there is a business during business cycle, like when recession comes, okay, you will learn this more about the business cycle in the industry analysis. So this is a very natural cycle that there is an economic downturn, and when there is an economic downturn, financially healthy company will be able to sustain during this phase of the economic cycle. Whereas if the financials of the company are weak, it won't be able to sustain and it may make losses. It may not create cash. Okay, so it will face a lot of problem. So when the company financials are healthy, it will be able to sustain. And secondly, it shows the management quality and efficiency. So how well the management is managing and controlling its finances, and how well they are utilizing those funds to grow. So this is what we already understood. Healthy financials help businesses to grow. And when the company grows, obviously we as a shareholder, when we want to buy the shares of that company, or if we have already invested our funds in that company, it will create value for us, which means there will be demand for the shares of such companies. And the company share price will keep rising on the upside, giving multi-bagger returns to the shareholders. Now, if the company financials are not good, if it is very weak, then the company itself, of course, they will face the problem. They won't be able to grow. They won't be able to sustain. And moreover, there is a very high risk of that company going bankrupt. And when the company goes bankrupt, it is not a good sign for the shareholders. So you should definitely look at the financials of the company, because healthy and strong financials reduces that risk to the shareholders of investing in that company. So your funds will be safe, your principal, your capital will be safe when you're investing in a financially strong company. Now, how are we going to analyze this? Okay, the financials of the company, as I mentioned, there are ratios, there are benchmark. Now, to analyze the financials, there are three different important tools that the company publishes. Okay, the first one is the profit and loss statement. Now, this statement is published quarterly and yearly. So in the Indian companies, as per the accounting rule, we use the financial year as April to March. So March ending is the yearly, where most of the company will publish their P&L statement, and quarterly will be from April, May, June, okay, July, August, September, October, November, December, and January, February March. So this quarterly results will be published 4 times in a year. Okay. The second important tool is the balance sheet. So the company publishes its balance sheet at the end of the financial year. So usually it will be published in March ending, and then the cash flow statement, which is again published at the end of the year. So these are the 3 important tools which company publishes. And using these 3 tools is what we are going to analyze and understand the situation or the condition of the company's financials. Okay, so here we understand what is financial analysis. How are we going to do this analysis is what we are going to learn in the upcoming videos. Here it is again, I'll just repeat, it's very important. When you want to invest risk-free in a company for long term to earn huge returns or multi-bagger returns, it is important that you invest your money in financially strong company. As we know, weak company can go bankrupt, and it can further, if anyone has invested money in that company, it can destroy his wealth, or it can even destroy his capital. Entire capital can be wiped out, and we don't want to take that unnecessary risk. So when you study, you analyze, and then when you put your money into that company, that is not an unnecessary risk. So let me tell you, these 3 tools are what we are going to learn and understand. Now, these 3 tools, whenever we are going to use, that is profit and loss statement of the company, balance sheet and cash flow statement, all the figures we are going to look for consolidated figures. Consolidated figures means, so you will have 2 options. One is standalone figures and second is consolidated. Standalone is the parent company, is the single company statement, the financial statement. Consolidated is including all the group companies together. So whenever we are going to analyze, whenever we are going to use these tools, we will use the consolidated one. So let me show you how do we understand whether the company's financials are strong. So this is how it will look. So you can see on the top, the graph that I have given over here. On the top, this is the sales figure. Okay, sales of the company, that is revenue. The second is net profit. Okay, that is the final profit of the company which they are making on any product or service that they are dealing with. The next one is the cash flow. And the last one is the debt or the loan that the company has taken. So when the company sales is growing, that sales has to get converted into profits. And whatever profit the company is showing in its P&L statement, it has to get converted into cash. And this sales has to be growing, net profit has to be growing consistently, and cash flow also has to be growing. And the debt or loan, whatever the company has taken to start the business, to invest in its business, that loan has to be reducing, or it should be debt free. This should be going down. So this is a very ideal situation. This, we call it as a healthy situation, where it becomes good to invest your money in such company. And investing in such company becomes risk-free. Now, let me tell you, you should not invest in a company. So there could be a situation where the sales of the company is growing. Okay, companies year on year sales is growing. They're making, they're selling their products. Okay, but the company may not be making profits, and this is possible. The company profits are going down, or they are even making losses. I will give you example for this when we will do the ratios. And the cash flow, it can be stable, or if the profit is going down, the cash flow can also be going down. Company may not be having surplus cash available with them. Okay, and the loan of the company is increasing. They are not able to repay their debt because the company is making losses. Okay, so such company, this kind of company is not good for investment. You should avoid investing your hard-earned money in such companies whose financials look like this. Okay. Now, sometimes it is even possible that the company sales is also not growing. So sales initially it has gone up, but after that it started falling down. The net profit was initially good, but after that they started making losses. The debt has been increasing. Okay, there are different situations. Okay, so this is what we will understand. What are the ratios for each and how to analyze, and to which ratio you need to give more weightage so that you can decide about investing your funds. So we will start with the ratios, each of the ratios and the 3 different tools, how to use them in the upcoming videos. Till then, bye-bye.